Happy Friday. It's Mark from Caliber Home Loans. I'm going to spend a couple minutes going through the market, the mortgage bond market. It is July 12th. So today we had a little bit increase in the bond pricing today, which pushed rates down a little bit. In fact, we just got repriced about 15 minutes ago for the better. So pricing got a little bit better for the conventional loans. So for the week, we can see that we actually are doing a little bit worse. So rates, there was some pushback on rates during the course of the week. Part of what's going on is the Fed, the expectation of the Fed and what they're going to do at the end of the month. Some are calling for a half-point reduction in the Fed funds rate. I think that's a little extreme. Others want a quarter point. Some think that not anything is going to happen. So at this point, it's all data-driven. We're just going to have to wait and see what happens. So again, the last week, again, this is a graph of bond pricing, and the price and the rate runs in opposite directions. So the price dropped a little bit over the course of the week, which pushed rates up a little bit. And then over the last month, we're a little bit higher than where we started a month ago, which means that rates pricing a little bit better. And then from the beginning of the year, we're still up from the beginning of the year, so we're still in an upward trend. But there is a little concern, and I'm concerned that with this talk of the market wanting the Fed to drop rates, what usually happens if they don't, then mortgage bonds and sometimes government bonds will actually move in the opposite direction and they'll get worse, so rates will go up. So remember, everything is based on expectations. If the market expects something to happen, they build it in, whether it's stock prices or bond prices. You know, if they think that Apple is going to come out, is going to be $100 a share, and it's not based on a report, then the market will react because of what the expectation was. And then also remember that good news on Main Street is bad news for bonds because it's considered inflationary. So good news is job numbers go up, unemployment goes down, inflation numbers go down. So that's actually good news, and that would help reduce rates. But if it looks like inflation starts to go up, the bond traders will want more for their bang. So they're going to want a higher yield. And the Fed isn't going to want to cut rates. They're going to want to increase rates to hedge against that. So it's really data-driven. At this point, it's really based on expectations and who you talk to and who you listen to. And I can listen to 15 different people and get 15 different answers. So I think that they're probably going to be on course to drop rates a quarter point at the end of the month, but we'll have to see what happens with that. In the meantime, the bond market will be under a certain amount of pressure just because nobody is really quite sure what to expect. I will be around all weekend. Remember, MSHDA has dropped their rates, so we're qualifying more people for MSHDA programs. And they're only about 5 days behind in underwriting, which is actually pretty good. So they're pulling files from the 8th. So give me a call, 248-705-8431, and let me know how I can help you and your clients.